Hey everyone, welcome back to Corporate Decoder. Today's just filed their 10Q report and I am spotting some interesting moves in their debt and cash flow that matter. Quick note, this is not financial advice, just my take on public filings for educational purposes. Sensata's debt is shrinking while their cash generation is strong. But some of their restructuring charges are still a bit of a puzzle. Alright, let's dive into Sensata Technologies, holding PLC's latest quarterly report. This document gives us a snapshot of their financial health from April to June of 2026. First, let's look at their balance sheet. As of the 30th of June 2026, they had about $6.6 billion in total assets. That is down a bit from about $6.8 billion at the end of 2025. On the debt side, their long-term debt has significantly decreased from around $2.8 billion at the end of 2025 to about $2.4 billion by mid-2026. That is a good sign, showing they are paying down their obligations. Shareholders' equity, which is what is left for the owners after all debts are paid, stands at $2.96 billion, up from $2.78 billion at the end of 2025. This increase is mostly due to higher retained earnings, meaning the company has been profitable and kept that money. Now, let's talk about how much money they are actually making. For the 3 months ending the 30th of June 2026, their net revenue was $990.6 million. That is up from $943.4 million in the same period last year. Looking at the first 6 months of 2026, net revenue came in at $1.925 billion. An increase from $1.854 billion in the first half of 2025. So sales are growing, which is always a positive sign. Their operating income also saw a nice jump. For the first 6 months of 2026, it was $307 million, up from $260.3 million in the same period of 2025. This means they are becoming more efficient at turning sales into profit. Cash flow is super important, and Sensata generated $332.5 million in cash from operations in the first 6 months of 2026. That is up from $260.1 million in the same period last year. They use a significant amount of cash for financing activities, totaling $468.5 million in the first half of 2026. This was largely due to paying down debt. In fact, they paid off $401.1 million in debt during this period. They also continued to return money to shareholders through dividends and share repurchases. Looking at the changes in shareholders' equity, we see that retained earnings have grown, pushing up the total shareholders' equity. This growth in retained earnings is a direct result of previous periods' profits. They also repurchased shares, which reduces the number of shares outstanding and can increase earnings. Purse hair. Diving into the notes gives us more color. They mention a transformation plan that started in 2025, aiming to restructure the business for better future growth. This involved things like workforce adjustments and site closures. They expect to incur charges between $16 and $24 million for this. In the first 6 months of 2026, they had restructuring and other charges totaling $2 million. This is a big drop from $13.6 million in the same period of 2025. This decrease is mainly because a lot of the transaction-related costs from business divestitures happened in 2025. The debt section is pretty significant. In May 2026, they announced a tender offer to buy back some of their senior notes. They ended up buying back about $406.1 million worth of their 4.0% senior notes in June 2026. This is a strategic move to reduce their interest expenses. Sensata organizes its business into 3 main parts: automotive, industrials, and aerospace, defense, and commercial equipment. Their automotive segment saw revenue grow by 3.3% in the second quarter of 2026 compared to last year. The industrial segment also grew by 2.9%. The aerospace, defense, and commercial equipment segment showed the strongest growth, up 11.5%. This shows healthy demand across their different business areas. Looking at where their sales come from, the Americas make up the largest portion, followed by Asia and the rest of the world, and then Europe. China is a particularly significant market for them, with revenue of $544.8 million in the second quarter of 2026 on the automotive segment side. The management discussion section gives us their perspective. They reported a 5% increase in net revenue for the second quarter of 2026 and a 3.8% increase for the first 6 months of the year. They attribute this growth to strong performance in their automotive and aerospace segments. Sensata also uses what they call non-GAAP financial measures. These are ways to look at their performance that adjust for certain items like restructuring costs or currency changes to give a clearer picture of ongoing operations. For instance, their adjusted operating income for the second quarter was $193.3 million, which is higher than their reported operating income. They believe these adjusted figures better reflect the underlying health of the business. As for liquidity, they ended June 2026 with over $400 million in cash and cash equivalents. They have a revolving credit facility which provides them with significant borrowing capacity if needed. They feel confident that these resources are enough to cover their needs for at least the next year. In the second quarter of 2026, they bought back some of their own shares, about 166,910 shares. This is part of their overall strategy to manage their capital effectively and return value to shareholders. The buyback program still has about $257.3 million remaining. My take, so, what does all this mean? Sensata seems to be on a solid footing. They are growing their sales across the board, especially in their aerospace division, and they are actively paying down debt. The restructuring charges are coming down, which is good to see. However, I am watching their reliance on these non-GAAP measures. While they can be useful for understanding core operations, it is important to remember the GAAP numbers are the official ones. The fact that they are strategically buying back debt is a strong signal they believe they have enough cash flow to manage their obligations and invest in growth. What I am actually looking for is how effectively they continue to integrate their new segment structure, and if the growth in aerospace can continue to offset any potential slowdowns elsewhere. And the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.